Look, I need to talk to you about something that is happening in Bitcoin right now that most people don't fully understand, and it's going to sound provocative when I say it, but hear me out. By 2030, maybe sooner, the ability to buy Bitcoin as we know it today, where you can actually accumulate meaningful positions at accessible prices, that window is going to close. Not because Bitcoin fails, but because it succeeds so completely that the dynamics fundamentally change. I'm Raoul Pal, and I've spent my career analyzing macro trends and trying to identify structural shifts before they become obvious. And what is happening with Bitcoin's supply dynamics right now is one of the most significant structural shifts I've ever witnessed. This isn't about price predictions or short-term trading. This is about understanding that we are in a very specific phase, the accumulation phase, and that phase has a limited duration. Hit that subscribe button, because what I'm about to explain connects supply dynamics, institutional adoption curves, and market structure in ways that completely change how you should think about positioning in Bitcoin. Let me start with the fundamental issue. Bitcoin's available supply is disappearing. Not the total supply that's fixed at 21 million and will never change, but the supply that's actually available to buy, the liquid supply that flows through markets, that's shrinking rapidly, and the rate of that shrinkage is accelerating. Here's the math. Of the approximately 19.6 million Bitcoin that have been mined, probably 3–4 million are permanently lost, sent to addresses with lost keys, locked in wallets nobody can access, holdings of deceased people with no recovery. Those coins are effectively out of circulation forever. Then you have long-term holders, who accumulated years ago and moved everything to cold storage. These are people who understand Bitcoin's monetary properties and have no intention of selling. They're not traders, they're holders with multi-decade time horizons. That's another several million coins. Then, and this is the critical new category, you have institutional custody. The Bitcoin ETFs, corporate treasuries like MicroStrategy, payment companies like Block and Tesla, sovereign wealth funds quietly accumulating potential strategic national reserves. This category is growing by tens of thousands of Bitcoin monthly, and it essentially never shrinks. Institutions accumulate over time, they don't distribute, so the actual liquid available to buy supply is maybe 3–4 million Bitcoin, and that number decreases every single day as more flows into permanent holders and institutional custody. Now think about the demand side. We're at the beginning of institutional adoption. The ETFs launched in early 2024 and absorbed hundreds of thousands of Bitcoin in their first year. BlackRock, Fidelity, and other major players are building distribution infrastructure to every financial advisor, every pension fund, every endowment in the traditional finance world. When pension funds allocate 1–2 Bitcoin, when sovereign wealth funds begin strategic accumulation, when corporate treasuries diversify into digital assets, the demand is measured in tens of billions or hundreds of billions of dollars. There simply isn't enough liquid supply to meet that demand at current prices without significant repricing. This creates a mathematical inevitability. As available supply approaches zero and institutional demand continues accelerating, we reach a point where the market structure fundamentally breaks down. Not because Bitcoin fails, but because scarcity reaches such an extreme level that normal price discovery mechanisms stop functioning properly. Let me walk through what that breakdown looks like. First, you see volatility increase dramatically, not because Bitcoin becomes more risky fundamentally, but because small buy orders move the price significantly when there's no supply to absorb them. Someone tries to buy 10,000 Bitcoin and the price jumps 15–20 because there aren't enough sellers at that level. This creates headlines about instability, but what's actually happening is the market reflecting extreme scarcity. Second, spreads widen substantially. The difference between bid and ask prices grows from a few dollars to hundreds or thousands. Market makers can't provide liquidity efficiently because there's no inventory. This makes execution increasingly difficult, particularly for larger orders. Third, exchanges run low on Bitcoin to sell. They show prices based on the last trade, but when you try to execute, there's limited supply available. You want to buy 1 Bitcoin, the exchange can only fill 0.2 because that's all the inventory they have access to. This is already starting to happen during high demand periods. Now, here's where it gets really important. As this dynamic intensifies, there's a shift from ownership to exposure, when you can't easily buy actual Bitcoin either because of price or availability. The financial system creates products that give you exposure without ownership. You buy an ETF that holds Bitcoin. You buy a derivative that tracks Bitcoin's price. You buy a structured product from a bank that provides Bitcoin exposure, but you don't own Bitcoin. You own a financial product backed by Bitcoin held in custody by an institution. This is a critical distinction. When you own Bitcoin in self-custody, you have absolute sovereignty over that asset. No counterparty risk. No one can freeze It seize it or deny you access. It's permissionless. When you own exposure through an intermediary, you're back in the traditional financial system, trusting institutions, accepting counterparty risk, operating within permission structures. For people who accumulate Bitcoin now, while they can still take self-custody, they retain that sovereignty. For people who come to Bitcoin after institutional custody has locked up most of the supply, they'll only have access to financial products, not the underlying asset. They'll rent exposure rather than own the property. This isn't a failure of Bitcoin. It's actually evidence of success. Bitcoin was designed to be the hardest, scarcest money ever created. As it succeeds at that, as the largest capital pools in the world recognize its value and compete to accumulate it, the natural outcome is that supply gets locked up by those who understand it first. Every scarce, valuable asset in history has followed this pattern. The early adopters who recognize value accumulate at lower prices. As awareness spreads and larger players enter, prices rise and accessibility decreases. Eventually, ownership becomes concentrated among early movers and large institutions, while later entrants have limited access at much higher prices. This isn't unique to Bitcoin, it's how scarcity works in markets. What is unique is the transparency. You can watch this happening in real time with on-chain data and publicly disclosed institutional holdings. Now let me address the timeline. Why 2030? The adoption curve for new technology follows an S-curve. We are currently in the early stages of institutional adoption, the steep part of the curve where growth accelerates rapidly. The ETFs were just the beginning. Every major financial institution is now building Bitcoin infrastructure, not because they love crypto, but because client demand is forcing them to. Once that infrastructure is fully built, once Bitcoin allocation becomes a routine part of portfolio construction, the capital flows are massive. A 1-2 allocation from the global pension system alone would absorb millions of Bitcoin. There aren't millions available at any reasonable price, so we get significant repricing, which simultaneously validates Bitcoin and prices out retail participation. When Bitcoin is $500,000 or $1 million, regular people aren't buying whole coins. They're buying tiny fractions, and increasingly, they're just buying exposure through funds because that's more accessible. By 2030, this transition is largely complete. The bulk of available supply has moved into institutional custody and long-term holders. The market is thinner, less liquid, and access for new participants is primarily through financial products rather than direct ownership. Here is what I think people misunderstand about this scenario. They think it means Bitcoin failed its mission. But Bitcoin's mission is to be uncensorable, unseizable, permissionless money for those who hold it, and it's succeeding at that perfectly. The fact that institutions want to accumulate it validates the store of value thesis. The fact that nations might hold it as a strategic reserve validates the monetary thesis. The fact that supply gets locked up permanently validates the scarcity thesis. Bitcoin is working exactly as designed. The consequence is that the window for accessible accumulation closes. That is not a flaw, that is the natural outcome of a fixed supply asset being recognized as valuable by increasingly large capital pools. Now, here's the practical implication. We're in that accumulation window right now. You can still buy Bitcoin at prices that, while high compared to a few years ago, will likely look extraordinarily cheap in hindsight. You can still take self-custody and own it outright. You can still position before institutional demand fully accelerates. That window is narrowing, not into 030, that's when it's closed and obvious. The window is closing progressively over the next few years as more supply moves into permanent holders and as prices rise enough to make retail accumulation impractical. The people who understand this are accumulating systematically, not because they're speculating on near-term price movements, but because they recognize they are in a specific phase, the phase where access is still possible, and that phase is time-limited. This is why I've been consistently advocating for meaningful Bitcoin allocation, not 100% of portfolios. That's irresponsible. But 5-10 of investable assets for those who understand the thesis. It's not about getting rich quick. It is about participating in what I believe is the greatest store of value asset of our time while participation is still accessible. Let me be clear about what I am not saying. I am not saying Bitcoin goes to some specific price by some specific date. I'm not saying it's risk-free. I'm not saying everyone should mortgage their house to buy Bitcoin. Those are all bad frameworks. What I am saying is that we are in a structural transition where an asset with fixed supply is being recognized by institutional capital and nation-states as valuable. That recognition is permanent and accelerating. The mathematical outcome of fixed supply meeting expanding demand is repricing and reduced accessibility. If you believe Bitcoin has value as a store of wealth, as digital property, as a hedge against monetary debasement, then the question isn't whether to accumulate. The question is whether you do it while it is still accessible at scale or whether you wait until that access is functionally closed off. The risks are real: regulatory uncertainty, technological challenges, market volatility. You need to size positions appropriately and understand that this is a long-term hold through volatility. But the opportunity cost of not participating, of waiting until the dynamics I'm describing become obvious to everyone, that cost could be enormous. Here's my framework. Accumulate systematically over time rather than trying to time markets. Dollar cost average if that helps psychologically. Take self-custody if you have the technical competence. Hold for multi-year time horizons. Don't panic sell during volatility. Rebalance intelligently, but don't trade your position away. And understand that the goal isn't to catch the perfect entry or exit. The goal is to participate in the structural shift while participation is still possible. By 2030, the shift will be complete. The ownership distribution will be locked in. And the question won't be what price Bitcoin reaches, it'll be whether you accumulated any during the window when accumulation was still accessible. I've been in financial markets for decades. I've seen multiple technology adoption cycles. I've analyzed countless assets, and the Bitcoin supply dynamics we are witnessing right now, the rate at which liquid supply is being absorbed by permanent holders, this is unlike anything I've seen. It's not hype, it's math, fixed supply, increasing demand from the largest capital pools on Earth, accelerating institutional adoption. Those inputs produce one output: radical repricing and constrained accessibility. The window is open now. You can verify everything I'm saying. Look at on-chain data, track institutional holdings, watch ETF inflows, study adoption curves, do your homework and make an informed decision. But understand that this decision has a time horizon. You can't make it in 2032 the same way you can make it today. The dynamics will have changed, the access points will have closed, the ownership distribution will be locked in. If you found this valuable, leave a comment and tell me where you are in your Bitcoin journey. Already holding? Building a position? Still researching? I want to hear what resonates and what questions remain. Share this with anyone thinking about Bitcoin, and subscribe because we're going to keep tracking this adoption curve, these supply dynamics, this institutional transition throughout 2025 and beyond. By 2030, buying Bitcoin won't matter anymore, not because Bitcoin failed, but because the accumulation phase will have ended and the ownership will be locked in. The question is whether you position during that phase or whether you'll spend the next decade watching from the outside. That's the message. The window is open. The clock is ticking. Position accordingly.